The next paper that we have is IPO suspensions. Is that correct?
Yes.
Okay. IPO suspensions and venture capital activity. Joanne, you have the floor in terms of the presentation, and your discussant is Thir, who is from the National Stock Exchange, one of the larger equity markets in the country, and should do a good job of supervision. So Joanne has got 15 minutes, and you are to alert her whenever her time is coming to a close. And Joanne, Thir will have 10 minutes of a discussion. And when he's speaking, of course, you have control on telling him when his time's coming up. So with that, and then we have 10 minutes that go into the floor discussion. With that, Joanne, the floor is yours.
Great. Thank you so much for the opportunity to present our paper at the conference, IPO Suspension and Venture Capital Activity. The paper is joint work with my colleagues Mark Humphery-Jenner from UNSW Sydney and Zhiyi from Changzhou University. So in terms of the motivation for the paper, what we'd like to do with this paper is sort of revisit some of the earlier evidence we've seen around the importance of IPOs for venture capital activity. So some of the earlier evidence suggests that IPOs are an important mechanism for VCs to exit their investments. And in fact, Black and Gilson back in '98 argues that they are actually critical to the existence of a VC market. So they allow the VC and the entrepreneur to enter into this explicit contract over future control of the firm. They provide a financial incentive for equity compensated managers to expend effort, as well as them providing an important avenue through which the VC itself can monetize its investment and return money to their investors. So IPO markets, it's also argued, can also more broadly impact the VC ecosystem. So Zheng and Wells argue that it should have a positive effect on both the demand and the supply of VC funds. On the demand side, an IPO market gives an exit, this exit mechanism will give the entrepreneur additional incentives to start firms. And on the supply side, you might have large investors being more willing to give funds to VC firms if they feel that there's a way in which they can later recoup their investment. So effectively, the availability of an exit channel is suggested to influence VC fundraising. So there's some earlier work shows that the quantity of VC-backed IPOs in a particular year is positively correlated to VC fundraising in the following year, as well as some evidence suggesting that developed stock markets actually have a positive effect on VC activity and VC exits. However, the previous research has indirectly tested how IPO markets can impact VC investment due to this difficulty of ensuring causation. And so we've seen there's generally a link between public markets and VC activity, but we know that there are myriad institutional differences between countries, as well as the issue that the conditions that produce a more valuable stock market are also more likely to be highly correlated with the conditions encouraging startup investment. So effectively, there's an identification issue when you're trying to analyze this relationship between IPO market conditions and VC investment. So we use the suspension of China's IPO market as an exogenous shock to venture capital in China. So if you look at IPOs as an exit mechanism across different markets, you can see there's quite a bit of variability. So just some data here, looking just at the percentage of exits that are IPOs. You get similar results when you look at deal value as well. But you can see that in some markets, in Asia, particularly in China, Japan, and South Korea, quite heavily reliant on IPOs as an exit mechanism compared, say, to Europe or the US. So why China? Well, effectively, VC has been an important force in China's industrial transformation, and we know that China's VC market now ranks second to the US. Some prior research has shown that IPOs are the main exit mechanisms for VCs to exit Chinese portfolio companies. But we know that China has relatively nascent domestic capital markets. It has haphazard regulation, as well as having instituted significant changes to its regulation of both IPOs and M&As. And in fact, the regulatory authority, the China Securities Regulatory Commission, or the CSRC, has suspended IPOs 9 times between 1994 and 2016. And these suspensions have lasted anywhere between 3 months in 2001 and 15 months between 2012 and 2014. So these suspensions, then, we argue, give us this opportunity to treat them as an exogenous shock and have a look at their impact on VC activity. And anecdotally, there's sort of 2 potential impacts of the VC suspension. On the one hand, some market players argue that the suspensions have made investors very reluctant to invest in domestic VC funds. But on the other hand, other players argue that, well, suspension of the IPO market might create opportunities for VC investment because firms are not able to raise capital in the public market and need to go back to the private market to get that capital, and they may be able to, the PEs may be able to raise this at very advantageous terms. So there are really sort of 2 schools of thought about the suspension. One is that suspensions are simply perceived as short-term events. VC investments are longer term. They're in privately held companies. These are illiquid investments compared to public debt and equity investments. So effectively, an argument could be that suspensions are not expected to have much of an impact. The counter argument is that IPO suspensions might actually generate a lot of uncertainty about the future of IPOs in China. That is, a potential change in IPO regulation or stringent future restrictions on the number of IPOs. And so therefore, we argue that this uncertainty could have a spillover effect on all VC activity. That is, contemporaneous VC investment could be reduced. VCs might change the types of deals they invest in. For example, they may choose less riskier deals, later stage companies, non-high tech, use of syndication. They may exit then in the future through alternative mechanisms, M&A or foreign IPOs, and it might also have a contemporaneous impact on fundraising for new VC funds. So how does the IPO process then work in China? It is strictly regulated, and this is in contrast to the registration and disclosure system that we see in most developed markets. It's an approval process that is administered by the CSRC, and they control the aggregate approval rate for IPO applications. So there is a concern that perhaps too many IPOs at any one period of time might reduce liquidity or pull down the market, or alternatively adversely affect incumbent public firms. So the IPO approval process is quite long in China and can take anywhere between 1 to 3 years. And the CSRC typically rejects 20 to 30% of all IPO applications, although this rate does vary over time. So we therefore argue that firms cannot time their listing. It takes multiple years for an application to be approved. And once they're approved, they tend to apply as soon as they can, or that is, as soon as they meet the listing requirements, which has to be within 6 months. So therefore, we argue that IPO suspension is really an extreme form of regulation. It pauses all IPO activities beyond the application submission step. In addition, the start and end of suspensions are not known. They're determined at ad hoc meetings. So suspensions are announced at the time that they start, and they end at the time that they are announced that they're ending. So you could potentially argue that, well, there's an incidence of historical suspensions, and this suggests perhaps that the market participants know a suspension is possible, but it doesn't necessarily mean they're able to predict them. Certainly no official explanations are given for these suspensions, and therefore this inability or limited ability to time the IPO market enables the causal identification. So in terms of our methodology, we run a series of regression analysis looking at VC activity against a whole bunch of controls and an indicator for IPO market suspension. That is, the first round of the investment is undertaken during a suspension. And we also look at the proportion of rounds invested during an IPO suspension. And our dependent variables include deal size, deal characteristics, whether it's a high-tech deal, syndicated, or the stage of the deal, as well as looking at type of exits and location, and fundraising, the number of new funds per month and the target amount. And as controls, we include deal characteristics, VC characteristics and experience, such as prior deal and exit experience, the type of VC, that is a government versus, and also domestic versus international VCs, as well as age and fund size. And we also look at sort of stock market and macroeconomic indicators as well. So we focus on first round deals for most of the analysis, and also control for both industry and portfolio firm location. So we use the province of the portfolio firm, that the province of the portfolio firm is located in as a fixed effects. And we also use a provincial marketization index. So one of the interesting things about the Chinese market is that there is regional disparity in institutional development. And this might impact venture success. And so we use a marketization index that's been developed to measure this variation across regions and time. So our sample data is from CV Source, which is a Chinese data provider that is now being more commonly used. And our fundraising data is from Zero to IPO. Our sample runs between 1992 and 2017, and we'll finish in 2017 in terms of investment to allow portfolio firms time to exit. So we have just over 21,000 portfolio firms that received close to 31,000 rounds of financing from close to 7,800 VCs. Their mean deal amount is about just over 44 million US. Syndicated deals make up about 30% of our sample, high-tech 37%, and early stage deals make up close to half our sample. In terms of our exits, we have about 2,500 exits, of which 57% are IPOs, and 16% of our IPOs are in a foreign market. And in terms of funds raising capital, we have just over 7,200 funds that raise in our sample. So in terms of our results, when we look at deal characteristics and deal size, there is initially a negative relationship between IPO suspension and deal size. So this suggests that during a suspension period, VCs tend to invest less in a portfolio firm. So essentially, we argued that...
You have 2 more minutes.
Okay, I've lost track of time. I'll speed that up. So effectively, we have a negative relationship with deal size. So you're less likely to, you put less money in, you're more likely to invest in high-tech firms and less likely to invest in syndicated and later stage deals, which is pretty much what we expect. Later stage deals obviously are closer to exit. High-tech firms, one could argue that you may go for more high-tech firms because having innovation assets may be more valuable for an acquisition exit. And deal size is lower because of the impacts of uncertainty of exit. We also look at the firm level, the number of rounds and the total invested. And certainly firms that have IPO suspension in the first round tend to have more rounds over their life and less capital invested. Again, we argue to reflect the uncertainty associated with VC investment. Similarly, we look at the probability of exit and IPO suspension. And here, once again, if you have investment in the first round when the IPOs are suspended, or you have a high proportion of rounds with suspension, you're going to be less likely to exit, and it's also going to take you longer to exit. Again, consistent with our uncertainty story. We also look at exit types. That is, you're less likely to have an IPO exit if you've received a first round during a suspension. And so we're not here talking about contemporaneous exits. Rather, if you had suspension during a first round, in general, going forward, you're less likely to use an IPO. And you're also obviously more likely to have an offshore exit. And in terms of fundraising, we see that funds raising during an IPO suspension, there's less of them, and they tend to have a lower target amount when they raise capital. So we do a whole set of a standard in corporate finance, a whole set of robustness tests, which you can have a look at, that's in the paper. So just to conclude, we use the suspension of China's IPO market as an exogenous shock to VC in China. So we argue that IPO suspensions have generated uncertainty about the future of IPOs, and this then has a spillover effect on VC activity. So we find that contemporaneous VC activity decreases, deal characteristics change, VCs are more likely to invest in high tech, less likely to invest in late stage and syndicated deals. And in terms of exits, firms that have received investment during a suspension period are less likely to be exit and take longer to exit, and more likely to use M&As and international IPO markets. And this, just to clarify, is not, we're not looking at exits during an IPO suspension period. And in terms of fundraising, the number of new funds raising capital and the fund target amounts also decrease. So all of this suggests that this lack of access to public markets dampens VC activity and really provides now stronger support for some of Black and Gilson's assertion around the importance of IPO markets to VC activity.
Thank you. Just go and discuss that.
Yes. Till you're on, and Joanna, now you get to return the favor. He's got 10 minutes.
Paper is on IPO suspensions and venture capital activity. And let me just go quickly to the background. Yeah, so the paper actually takes up an important, background question in finance, which you can see in the Black and Gilson paper of '98. It basically compares a bank-funded economy versus a capital markets-funded economy and tries to make the distinction that the linkage of the venture capital activity in a market-funded economy is crucial in an active market, therefore, is absolutely important for a thriving venture capital market. And in this case, the exit through an initial public offering is absolutely important for the VC investment market, and they consider the US market, which is what Joanne sort of spoke about. And there have been several papers in the literature that link this particular part, and we saw that in the presentation as well. And however, as Joanne sort of pointed out, markets differ. They differ meaningfully across geography. So let's say in emerging markets like India, you have only about 9% or 9.5% of VCs that actually have IPO exits. And US, it goes marginally higher, 12.5%. But in countries like Japan, Korea, and China, it's 2/3. Most VC investments see an IPO exit. So that's the major difference between markets. It's not just enough to look at linkages. It's also important to distinguish what Joanne spoke about as identification problems. There are several other factors which could lead to a link between private markets and public markets. It's important, therefore, to consider that what you see are associations and not necessarily causal inference. And that's sort of the key, key input of this paper, which uses the IPO suspension market in China as an exogenous shock to see if there is, we can draw some causal inference between VC activity and capital markets, secondary markets. So here's the background. Joanne spoke about it, but the numbers did appeal to me. So there are two parts here. The Asia market has about 3,800 listed companies. Market cap is 8.5 trillion. IPOs are there from 1990. The big exchanges came there. Shanghai in 1990, Shenzhen in 94. It takes a long time for IPOs to get approval, meaningfully, a long time. The acceptance rate, Joanne spoke about as failure rate. I took it the otherwise. So an acceptance rate is only about 70 to 80%, and it is uncertain. And there are several reasons why an IPO can be rejected, but they're not given out. So and plus you have this added mix of an IPO suspension. So despite all that, the VC funding market is about $70.5 billion, which is about a third of the global market. There are 7,000 plus VC funds, and AMC is about, asset under management is about $150 billion. So average duration is about 6 years there. And in our data, you have a sample size that ranges between 1992 and 2017. And if you see in the paper, the deal numbers, the deal sizes, they keep increasing from the early 90s all the way till 2015, where they sort of peak out. And mean deal size, as Joanne pointed out, is about $44 million. And roughly, in their sample, about 57% have IPO exits. The question that the paper is sort of asking is, how do public markets, specifically IPOs through IPO suspensions, they affect venture capital activity? And what's different here in this paper, as I mentioned earlier, the random nature of the IPO suspension as an exogenous shock is used to analyze its impact on the VC market, to draw causal inference. Just to, there are several regression analysis in the paper. What we've done here, and thanks Anisha also for this. I've just mentioned some of the questions that are being asked here. So, deal size is sort of, regressed on. There are several factors that Joanne sort of spoke, discussed about. So there are, regressions on deal size, regressions on what deals are high-tech investments, what happens with syndication, what happens with late-stage deals or early-stage deals. I will go to the results and conclusions here. How do the number of rounds determine whether there will be a successful exit or not? How does a successful exit also determine the amount that was invested in the paper, in the particular deal? And what are the reasons behind successful exits? Are there, what are they sort of qualified by IPO exits, or if there are offshore exits? So there are a couple of clarifications. I'll come to the clarifications later. Quickly, what are the conclusions of this paper? What are the results of this paper? So there is an association between the stock markets and venture capital ecosystem. VCs want a good exit. It helps them return capital to their limited partners. This is also something that's mentioned in the paper. And which essentially means that if you want to encourage risk taking in terms of venture capital coming into the startup ecosystem, nurture it, take that risk, then you have to have a thriving IPO market, which will allow them the requisite exit. And if this particular market is uncertain, this particular market is suddenly closed, like that happens in China. So you had 9 suspensions, entirely random, in this particular sample, between 1992 and 2017, and that colors VC behavior. And this is something we see in the paper. What happens then? So once bitten, twice shy. IPO suspensions, basically they narrow the means by which VC can generate returns. So investments go down, valuations in those investments sort of go down, and then they become a little more conservative. So after an IPO suspension, there are many more rounds of discussion, and the eventual ending in terms of funding is lower. They also hold their portfolio for longer, and this sort of makes them go for sectors which require longer horizons of investment. So high tech sector is one such sector. It has a longer gestation period. It has it has IPR, and that sort of moves VCs towards the high tech sector. And this also sort of means if you're if you have a longer gestation period, then they actually go for early stage investments, which essentially I just mentioned earlier that the average investment period is 6 years for a company there. And then and when you have these suspensions, these random suspensions, VCs also look for alternate exits. So Alternate exits are an M&A or a foreign and overseas exit. These sort of move up. And one of the other things that Joanne also mentioned, that IPO suspensions, they significantly lower the number of funds raised and their size. So the policy implication, and which is a follow-up from Black and Gilson's paper, that a thriving IPO market is inextricably linked to higher levels of VC activity. What do we have here is a causal inference. And so my comments here and certain clarifications are, this is an interesting paper.
Sorry, can I just interrupt you? You've got a couple of 2 more minutes, so thank you.
Okay, thank you. So it's an interesting paper which looks at an old established fact and tries to give a causal inference using this exogenous shock. Some comments that I have, quickly. It'll be nice to have all the models, the mathematical models, all the regressions that are specified in the paper. That were in the paper. A lot of the mathematical activity, the results I could see only towards the end where I was going through the tables. It will be nice to have them together. It would also be, to probably make sense to have a slightly different specification. You might want to look at interaction terms. You might want to look at some matching in terms of deals that did go through and deals that did not. Does it make sense, since the time period is so long, 1992 and 2017, to have certain time effects as well? The dummy, for instance, when China entered WTO and things sort of opened up. And the classification for high-tech companies, we don't see any other classification. So we see whether a firm is a high-tech or not. What happens to the other sectors? It will be nice to have that. And yes, a high-tech company in the 2000s is not the same as what we have now. So other than that, good paper. All the best for publication. Thank you.
Thanks, Steve. Thanks, Joanne. Now the discussion is open to the floor. Joanne, would you like to comment or respond to Tir's comments first, or just take all the discussion questions coming from the floor? There are several. There are some.
Yeah, great. No, look, thank you so much for the discussion. I just will respond just to one thing, just to make a clarification, that when we look at exits, we're not looking at exits during an IPO suspension, because then you have a tautological relationship. So we have to exclude firms we're only looking at exits that are outside IPO suspension periods. But no, thank you very much for those comments.
Okay. From the floor, Ajay has a comment or a question.
Just some thoughts that were triggered in my mind. I have often encountered a thought process in the world of public policy where finance is viewed as a tap that you can switch it on and switch it off at will. And sometimes this is backed up with efficient market type arguments saying, you know what, people will figure everything out. The NPV will work out, the transactions will ultimately take place. Because finance is so perfect, policymakers sometimes feel they have the license to do anything in terms of switching on and switching off. And so when I see this paper, I think about hysteresis. I think about the idea that there are organizations in there are organizational capabilities, and financial intermediation matters. And those organizations and their capabilities matter. And those organizations get bruised when you switch on and switch off these things. And that has real world consequences. So I feel that's the larger setting and the context in which this kind of work is particularly interesting. One of the most pernicious places where we see this finance as a tap behavior is in the field of capital controls, where it is actually a very complex thing to build the organizations that will intermediate across the asymmetric information for cross-border investment. But so many policymakers, particularly people with a macroeconomics background and not a finance background, don't see the richness and the complexity of the human institutions that overcome this asymmetric information.
I think Jing has a question as well. She's raised her hand. Please go ahead. And next.
Hi, Joanne. Thanks for this interesting paper. I just have one question about your main dependent variable, the IPO suspension in the first round. I was thinking if this IPO has any impact, it will have a higher impact for any firm, any investment in the later round. So why do you choose in the first round instead of looking at the suspension, the investment during the later rounds?
Look, thanks for that question, Jing. So initially we started off looking at first round just to make sure we have a level playing field so that IPO suspension could technically impact the VC decision consistently across the portfolio firms. But as robustness testing, we also look at it across all rounds. And we do find similar, if not slightly stronger results for all rounds as well.
Thank you.
Hi, can I?
Yes, please, Koshi, go ahead.
Okay, a very interesting paper. And I think this is very important, partly because of the institutional issues which Ajay was talking about. So the way I think of it is there is issues about risk sharing. There is issues about how asymmetric information gets resolved at different stages. For example, I was watching a show recently about, there is a lot of claim, for example, in China, that, they are going to do the institutions right. And they want to avoid, inequality and distortions like that in other countries, especially the West. So that's one aspect of it. But, when you turn off, as Ajay was saying, when you turn off one part of the capital market, that affects risk sharing, as you pointed out, Joanne, and venture capitalists are not going to be doing the same thing they used to do. You might remember there was a big literature in the US where they were asking, how is the IPO market affected by whether or not there was an early stage involvement of the venture capitalists? Now, in a way, you're asking the other question, that is, if the IPO market somehow doesn't function as it should, how does it affect the venture capitalists? Well, the truth is, it's a bilateral risk sharing which is being shut down, and how information gets into the stock prices. So it affects asymmetric information. How much is it resolved by the venture capital process? How much is it getting resolved by the IPO process, and on and on, So this is I think it's a very interesting study because it does ask, as Ajay said, I don't think finance is perfect. Finance is not perfect, but shutting down institutions doesn't help things either, So that's so it's you guys should pursue this. There are a number of issues you can look at, and you do look at some very interesting issues. So I like your paper very much.
Susan, can I ask a question?
Vijay, you have the question. We are nearly out of time. So Vijay is the last question, and then Joanne, I'll give you a minute to wrap up if that's okay. Go ahead.
A quick one, Joanne. I think it's a very interesting paper. So one thing what I was trying to think of is the VC funding has dampened for IPO markets. Was there any spillover, like, did they go to other markets, so outside China, or, other kind of investments? So that might give a more complete picture, whether it has really dampened or not.
No, look, thank you for your question. So it depends what type of fund you are. So domestic funds can only invest in China. Obviously, international funds technically have a broader remit. And certainly we can look at sort of the international funds, whether their mandate is China focused only, whereas if they have a broader mandate that includes Asia or global, we could look perhaps at how they've changed their allocations around that period. But foreign VCs are playing less and lesser a role, I guess, going forward. And I think possibly, thank you for that suggestion, actually. I think we can try exploit the rise of domestic VC and how they get constrained in later periods compared to earlier suspensions. So thank you. That's great. Thank you for that.
So Joanne, is that it? Would you like to respond to Ajay and Koshi, or should we just bring the session to a close?
I'll just say thank you very much, Ajay and Koshi, for your comments, and sort of at least I think it's very useful in terms of positioning the paper and making it a sort of a broader issue, not just about China and IPO suspension. So thank you very much for that, and we will definitely incorporate those suggestions.
Great. Thanks a lot, Joanne, for having presented this paper.